What I want to talk about now, ladies and gentlemen, is how do you access these assets? What is the best way of going out and buying these assets? Well, there's only two ways, really. The first way is to go out there and invest directly, go out there and buy one of these assets, or the second way is to do it through a REIT. Now, a REIT, as you recall, is a real estate investment trust, and it's a fancy word for a managed investment scheme, what we call a managed investment scheme here in Australia. Now, I think it's fair to say, ladies and gentlemen, that unless you are a professional investor, then an easy way to access these assets is the same way that the vast majority of Americans access these assets, and that is through a REIT. And the REIT, or the managed investment scheme that we've set up here in Australia, it's Australia's first US multifamily property fund, and it gives us a lot of confidence that we've picked an asset class which I believe is far superior than residential asset classes, because it's a commercial-like property that is capable of commercial-like returns. Now, I'm going to explain to you how we've structured this and some of the unique benefits that are involved in investing in a managed fund. So let's have a look at how our fund is structured and why I think it is the best way for Australians to access US-based real estate, in particular from a tax point of view. And I'm going to show you that in just a moment. But the way any managed investment scheme works is investors like you and I, we all put our money together into a managed investment scheme. Now, our one is called the Equity US Multifamily Property Fund. It is an Australian fund. It is registered with the Australian Securities and Investment Commission, and it's operated by a responsible entity in Australia, which is an Australian public company, which is Equity Capital Limited. We then take that money. Now, we actually take that money and put it into a wholesale fund, and that's designed for institutional investors. So if you're looking at this diagram in your PDS, there's one extra box in there because we are offering it to the major institutions as a way for them to access these assets class as well, which is great for you as a retail investor, because it really does mean that you're investing alongside institutional investors. So we take that money, we send it across to the United States, we convert Australian dollars to US dollars. Now, we send that over there in two different ways. We either send it as debt or we send it as equity. Now, I'm going to leave that for now, and I'm going to come back to this in the next slide, because that is the essence of the structure that we're talking about. Now, a US REIT is a trust that has to have a minimum of 100 or 125 US citizens shareholders. We then take that money and we put that into limited liability companies, which is like another trust, and that's designed for every single property, and that's just an asset protection mechanism. So if something happens to one asset, it doesn't affect another asset. Now, there's two important parts to this. The first thing is our US partner, and one thing that makes us unique and perfectly positioned to take advantage of these assets is the partner involved, or what we call our asset manager. And this is Riverstone Residential, and I'm going to talk about them in just a moment. We're also therefore able to get traditional bank loans from the likes of Fannie Mae and Freddie Mac, which we're limiting in this fund to 50% gearing. We've all seen what's happened with listed property funds. We've all seen what's happened with overgeared unlisted property funds in Australia and right around the world for that matter. And what I want to do with this fund, or what we wanted to do, is we wanted to be a little bit conservative with our gearing and restrict that to 50%. Let's now focus in on the link between Australia and the USA. You can see here we've got two ways money goes to the US. If we transfer that money as equity, in other words, we just transfer the money across to the US, and we transfer a portion as debt, which means we're lending the money under a loan agreement to the US, we have the right to earn interest on that. Now, if you put in equity, you receive dividends on your equity, right? If you're part of a REIT and you satisfy the conditions of a REIT, then your US withholding tax is going to be restricted to 15%. In other words, if less than 10% of the fund is owned by less than 10% of the investors, or for non-individuals in a diversified REIT, which means it's buying more and more assets, then you get to benefit from a 15% withholding tax. Anything else is charged at 30%. So the fact that you're doing it through a managed investment scheme like this that has more than 10 shareholders, much more than 10 shareholders, you would receive the full benefit of that 15% withholding tax reduction. The second part, which I found very interesting, is that on the interest repayments that we get from the US, the withholding tax on that is 0%. Provided, of course, that you satisfy what they call the portfolio interest exemption condition is met, which basically means that you have a holding less than 10% of the total asset value, which in a managed investment scheme like the one we've set up, it's most certain that you would. Otherwise, you'd be paying 10%. Now, a very smart gentleman came up to me at the end of the Perth seminar and says, Danny, in that case, why don't you put all the money across to the US as debt and only charge interest and bring it down to 0%? Basically because the US-Australia double tax treaty prevents us from doing that. And as you can see there, next to debt, we've got the figure of 1.5. Next to equity, we've got the figure of 1.0. And there's a ratio restriction of 1.5 to 1 debt. So part of our formula is to calculate exactly the way to optimise that so we can bring the net tax down to sub 10% levels for Australian investors. The good thing is you get a full credit for that 10% anyway, which is quite good, because if you're investing through a self-managed superannuation fund and you're in pension phase, then your tax rate's 0. So it's more tax effective than that 15%, which is what our best tax rate is for accumulators. That alone, ladies and gentlemen, justifies the reason why, if I'm looking at investing in the US, why I should do it through the fund as well, as opposed to going direct, whether or not I had the means to do so. One of the most valuable parts of our fund is our ability to have appointed our US partner. Now, we flew over there a number of times to try and interview and talk to different companies. We downloaded a list of the top 100 multifamily operators. These companies are huge. We spoke to maybe 12 or 13 different companies, and when I say spoke to, we spent days with them. We went out, looked at their properties, looked at their operation, looked at their computer systems, looked at everything throughout their operation. And at the end, we decided on this company here. Now, this company here is the biggest operator of multifamily properties in the US. Third-party property management. They have over 4,000 employees. They manage over $15 billion worth of these properties and manage over 160-odd thousand apartments. The services that our partners will offer includes assisting us with the sourcing of properties, the acquisition of properties. They have appointed a full-time property acquisition person for us in the United States. People who can take guys like Gert out and take him out for dinner and become on their private client list and give them all the reasons why we should be forefront of their mind when they're looking at selling these quality assets. They also help us with doing the full due diligence. They help us with the management and, most importantly, with the repositioning of the assets of the fund. So Riverstone Residential is a third-party asset manager, and they manage properties for institutional clients. What's our investment strategy? We have a very clear investment strategy, ladies and gentlemen, and the product disclosure statement that you have does outline this in a lot more detail. But basically, what we want to do throughout this fund is to go out there and buy quality US-based multifamily real estate assets. We're looking at asset values between 10, 20, up to $50 million for each acquisition. Our goal is to raise $300 million over the next 3 years. That will enable us to buy a portfolio of $600 million portfolio of assets. That gives us very good diversification, not just in real estate assets, but also in areas. There are 5 or 6 primary areas that we're looking at focusing on. More importantly, we're looking obviously in A-grade areas, but we're looking for B or B- grade assets. Our aim then is to appoint our US partners, which is Riverstone Residential, to assist us with the repositioning of that asset. And what I mean by the repositioning is over a period of time, they will remanage those assets. They will put their management team in place. They'll put their day-to-day operators. They'll put their regional managers. They'll put their computer systems in place. And their aim is to increase the net operating income of those assets through the repositioning. And that could include some cosmetic renovation to the property and doing whatever else they feel necessary. If they feel they should put a dining room in there and charge $80 a night to rent out the dining room, then we value and we are grateful for their expertise and their opinion. So that's our strategy of the fund. Our strategy, very simply, is to take B- assets and improve them to become a B+ and possibly even an A- category. And with the quality of income comes better capitalisation rates and improved values, and with the repositioning of the asset comes better quantity of income. Okay? Why should Australians look at this? Well, first of all, I think it's a very good way to get access to quality US-based real estate investment opportunities. It is very much an opportunity-driven investment strategy. Our aim is to buy properties not necessarily below market cost, but certainly to buy below replacement cost. And there's a very big difference with that. So if we can buy them below what it costs to construct them, And we can do that over the next 3 years, which is what this fund is open for. It's open for the next 3 years so that we can raise money and continue to buy these assets. It has a clearly defined investment criteria, and again, I do encourage you to read your product disclosure statement. There's a lot of work and a lot of effort that's been put into putting every single paragraph in that document, and you will begin to appreciate not only the asset class, but the way in which the entire fund is structured to capitalise from some of these benefits. We have an experienced investment management team, which I've already touched on, a highly qualified US-based property management team. In my opinion, we've selected the best, which is Riverstone Residential. I do believe there are solid long-term fundamentals for multifamily real estate in the United States. And here it says cash flow and capital growth potential. The fund does plan to pay dividends quarterly. So as the rental income comes in, you receive quarterly dividends as an investor. And once again, I do want to touch on the tax efficient structure. I do believe that the structure that's been developed by our attorneys and accountants is possibly the best way of accessing international, in particular US-based real estate assets and taking advantage of the double tax treaty between Australia and America. So that is our fund, ladies and gentlemen. That's the way it's structured. That's the investment strategy and the asset class that we're looking at buying in. And I guess the question is, you need to ask yourself, is this right for you? Now, there's a few questions you need to ask. The first thing is, and I think most importantly is, are you happy or are you comfortable with the asset class? Because at the end of the day, whatever the asset class produces, whatever it produces in terms of yields and whatever it produces in capital growth is what you receive essentially as an investor. The next thing you have to decide is it right for you? So looking at that, there are 3 different ways that you can invest in this fund. The first way is obviously to deposit cash. We have made it available to as many people as we can, and we've made the minimum subscription amount $10,000. So you can invest $10,000 and then later on you can increase that by $1,000 increments. And you can continue to invest for an entire period of 3 years. At the end of that 3-year period, we will be closing the fund and we will not be buying any more assets. We'll then be managing those assets for a further period of 4 years. We will all get together again and we'll decide what we want to do for the remaining 3 years. If the investors decide that, hey, we've had a great run, we're getting great yields, maybe we should keep going, or maybe we should sell, or maybe we choose to do a combination of both. But then we can vote together and decide what we want to do. The other way is to access this is through your self-managed superannuation fund. The fund, whilst there is a very small percentage, 2%, that we allow to come out of the asset value for clients or investors to redeem their investments, you do need to appreciate the fact that this is an illiquid investment asset class. And the best way to make money long-term in real estate is to buy good quality real estate in good quality areas and hold on to that. And that's one thing that we've made extremely important with the structure of this fund. The third way, which I consider a more aggressive strategy and comes with its own level of risk as well, is to go out there and borrow money. And if you are producing yields that are potentially greater than the cost of borrowing money, then it does generate the opportunity to generate a positive net cash flow for you as well. Now, what I would like you to do in order to make an informed decision is step number 1 is read the product disclosure statement. Now, this is this documentation here that's been handed to everybody here tonight. So it's divided into 2 parts. Part 1, which talks about the structure of the fund, and Part 2, which will continually be updating as we acquire more and more assets within the fund. There is some good information here, everything from the tax structuring to the legal advice to the investment classes that we're looking at and the investment strategy. Please take the time to read that. There's also a very good report that we asked Marcus and Millichap to put together for us. It's written exclusively for us and it is an economist's point of view on what they believe is fundamentally happening and going to happen in the US economy. Once you've had the chance to read the PDS, then I think you need to consider, as it says here, consider the investment objectives of the fund in light of your own personal objectives. And if you're unable to do so, then I do recommend that you sit down and talk to a qualified financial advisor. Once you're satisfied with that and you would like to make an investment, at the end of Part 2 is an application form. You simply need to complete that application form and send that into registries along with your cheque, which is made payable to the custodian. Oops. And finally, as it says here, mail that into registries.